Feels like deja vu. We are back to Tariff Day, this time tomorrow. April 2nd, it all begins, and some very interesting stories relating to it. All sorts of volatility. Mostly to the upside, but other kinds of volatility as I'm about to share with you. Hello and welcome to the Northern Miner Podcast. My name's Adrian Pocobelli. And this story from a trade publication, manufacturingdive.com, which seems to specialize in manufacturing, kind of snuck under the radar, but seemed to say so much about the tariffs discussion, which, as experts have pointed out on this show and elsewhere, trade wars tend to hurt both sides. And check out this story. This is by Kate McGill, lead editor at Manufacturing Dive. Cleveland Cliffs lays off more than 1,200 workers as tariffs hit demand. A number of North American steel manufacturers are struggling to deal with the impacts of the Trump administration's trade policy. So here are some details here. Cleveland Cliffs is laying off workers in Michigan and Minnesota as the steelmaker attempts to mitigate the knock-on effects of the Trump administration's tariffs on steel and auto imports. And it's just another reminder of how massive and crucial the auto sector is to economies. The company plans to idle some operations in its Dearborn, Michigan plant due to falling automotive demand, leading to 600 job cuts, according to an emailed company statement. Cleveland Cliffs will also idle operations at 2 iron ore mines in Minnesota, resulting in 630 layoffs. Quote, these actions will allow the company to operate more efficiently and in a more cost-competitive way for the current market environment, end quote, the company said in its statement. It continues, quote, we believe that once President Trump's policies take full effect and automotive production is reshored, we should be able to resume steel production at Dearborn Works, end quote. But one wonders if they're going to hire back the same amount of people, thinking about the workers here. And just adding to that point, it's not like the workers were furloughed here until we learn more, a temporary pausing of working. And who's going to have all the leverage when they hire people back? And who are they going to hire back? It continues, steelmakers across North America are straining to address the impact of the Trump administration's sweeping tariffs. In February, Canadian steelmaker Canada Metal Processing Group announced that, quote, in light of lower anticipated demand and production volume due to U.S. tariff threats and trade challenges in Canada with increasing imports, end quote, it plans to lay off 140 employees in Ontario and Quebec. And you just imagine, again, how many of these jobs are going to come back, even if, business comes back. So, your heart goes out to these workers here. Marty Warren, National Director of the United Steelworkers Union, which covers members in the U.S. and Canada, said in a March 26 Reuters report that he has heard that at least 200 members have already lost their jobs. Experts have been cautious about the positive impact of steel tariffs on U.S. manufacturing. Marty Warren, National Director of the United Steelworkers Union, which covers members in the U.S. and Canada, said in a March 26 Reuters report that he has heard that at least 200 members have already lost their jobs. Experts have been cautious about the positive impact of steel tariffs on U.S. manufacturing, saying that while it's likely to drive up domestic steel prices and production capacity, they are unlikely to create many new jobs. Despite the recent layoffs, Cleveland Cliffs and other top U.S. steelmakers have been vocal in their support of the tariffs and pushed for the administration not to include any exemptions to the tax, unlike when similar tariffs were imposed in 2018. And here's a quote from Cleveland Cliffs Chairman, President, and CEO Lourenco Goncalves, who said in a February 25th earnings call, quote, the tariffs will penalize the foreign competitors who have been playing by a different set of rules while strengthening the domestic producers who actually invest in American workers, American manufacturing, and American supply chains, end quote. Competitor Nucor had been similarly vocal in its support, despite the fact that the company has some operations in Mexico, a joint venture with Japan-based steel manufacturer JFE Steel. The joint venture produces hot-dip galvanized sheet steel for automotive customers. Quote, we supply high-value added products into Mexico versus the commodity that's imported to the U.S. from Mexico, end quote, Nucor EVP of Raw Materials Noah Hanners said on a January 28th earnings call. The company's performance, however, is not looking as positive. In its Q1 guidance released on March 20th, Nucor said it expected its steel mills segment to perform similarly to Q1 as it did in Q4 2024, during which earnings fell 71% year over year. I guess they're desperate. If their earnings are falling 71%, it seems to me they are to be fair to these companies, hanging by a thread, if that's what's happening to your earnings. Very interesting. Before we jump to the new records in gold and copper, and just on that point, we have Cam Currie this episode as our featured guest with a wonderful interview on what is happening in the gold stocks and how he is approaching investing in gold, as well as some other metals we discuss as well. So a wonderful interview there, as well as a great spotlight that we have with Oroco Resource President Ian Graham on their project in Mexico. So lots to look forward to there. Now, continuing on the steel front, it looks like Nippon and U.S. Steel are closing in on a deal as they continue to consult with the White House. And as this Reuters story says, in recent meetings with White House officials, Nippon has offered to increase the $2.7 billion it had previously offered to upgrade U.S. steel factories to as much as $7 billion. The report said, citing people familiar with the matter. And it seems like the key thing that's happening here that is allowing this deal to go forward is that Nippon Steel's bid will take the form of an investment rather than a purchase, interestingly. So that is the latest on the Nippon Steel U.S. Steel saga as the world turns. Now, continuing over to gold, we have a new record here, $3,159.50 per ounce. As I look at the screen showing the futures here on CNBC, there are lots of reasons being given as usual. An interesting story in the Northern Miner, though, is quoting Goldman Sachs. Gold hits new high as Goldman sees $3,300 gold. And if we scroll down, it says here, coinciding with gold's rise, analysts at Goldman Sachs again bumped up their price forecast for the yellow metal. They're now anticipating $3,300 an ounce by the end of the year versus $2,890 to $3,100 an ounce forecast in late February. So it's only a month later, and the forecast is up almost 10%. The new projection, says Goldman analysts Lena Thomas and Dan Streven, reflects a pickup in gold purchase by central banks, which have bought over 1,000 tons for 3 straight years and are on track to repeat the same feat in 2025. I discuss this, of course, with Cam Currie. We go into macro. Here is what Goldman said in the note, quote, central banks, particularly in emerging markets, have increased gold purchases roughly 5-fold since 2022, following the freezing of Russian reserves. This is really the key, isn't it? This freezing of Russian reserves after the Ukraine war started really did change things for gold. And as they continue, we view this as a structural shift in reserve management behavior, and we do not expect a near-term reversal, end quote. They also noted flows into gold-backed ETFs, quote, surprised to the upside, end quote, with the renewed investor demand for hedges likely driving the expansion. They repeated their view for 2 rate cuts from the U.S. Federal Reserve this year. I mean, it's worth recalling Jeffrey Christian. The last 2 interviews was also attributing part of the cause of the rise in the price of gold to diversification from people who have done really well in a record stock market. It's not the most sensational reason, but it kind of feels like one of the least speculative. It's not a glamorous headline there, but it rings true, doesn't it? And finally, quote, while ETF flows generally track Fed policy rates, history shows they can overshoot during extended periods of macro uncertainty, such as during the COVID-19 pandemic, end quote, the bank's analyst said. Should accelerating demand for hedging boost ETF holdings toward the pandemic-level heights seen in 2020, prices may hit $3,680 an ounce by year's end, they added. So sneaking in almost a $3,700 target here should volatility increase. Very interesting. Continuing on the tariffs here, we have it impacting the copper market, which hit a new record last week. Here's the headline, Trump weighs imposing copper import tariffs in weeks, not months. This is Bloomberg News via Money.com. U.S. tariffs on copper imports could be coming within several weeks, months earlier than the deadline for a decision. According to people familiar with the matter, copper traded in New York rose to a record. And that record was $5.37 per pound. So that is a new record in copper. We have a new record in gold. Interesting times. Another interesting headline, copper supply in Asia tightens as tariff risks spur anxiety. This is Bloomberg News via Mining.com. As it says, the copper market in Asia is tightening, adding to signs of worldwide dislocation, as prices rally hard on speculation that the Trump administration will impose import tariffs on the industrial metal. I mean, the question for me is, when I read something like that, is this going to be a sell the news event? In China, the Yangshan premium, a gauge added on additional costs for shipping the refined copper, has nearly doubled this month. In Southeast Asia, meanwhile, import premiums have risen to the highest since last April. Copper has surged this year on bets that the U.S. will introduce tariffs, with New York futures rallying far more than the global benchmark contract in London. That unusual dislocation has been drawing stockpiles out of non-American markets into the United States. Kostas Bintas, a well-known trader at Mercuria Energy Group, said that recent shifts have been unprecedented. Quote, supplies of imported copper into China are tightening after cargoes from South America, Congo, are diverted into the United States, end quote, said Li Yaoyao, an analyst at Xinghu Futures. Net imports into the country already dropped 11% in the first 2 months of the year, as exports more than doubled. Imports may drop as much as a third for April and May from last year, Bloomberg reported last week, citing one large trader active in the Asian market. And finally, there are other signs of tightening in corners of China's copper market, the world's largest. The premium for cathode in Guangdong spiked to more than $28 a ton, according to Shanghai Metals Markets. That's the highest seasonally since at least 2020. The premium jumped following a recent surge in exports from smelters in southern province, according to Xinghu's Li. So very interesting, and just finally on this front, adding fuel to the fire. Protesters block roads to Glencore's Antapaque copper mine in Peru. This is Reuters via mining.com, and just a couple of lines here. Protesters are blocking access to Glencore's Antapaque copper mine in the Cusco region of Peru, a local community leader and a source close to the company said on Monday. Residents of nearby towns on Sunday began blocking roads to the mine to protest a major expansion project, said community leader Flavio Wanke. Very interesting there. Now turning over to Europe, it's a challenge to pack this all in to this program here. The EU has selected 47 strategic projects to secure critical minerals access. And this is by Cecilia Jamasmy at mining.com. The European Union has published its first list of strategic projects strengthening the local extraction, processing, and recycling of 14 of the 17 materials it deems critical for its energy transition and security. The selection of the 47 projects marks a key step in implementing the Critical Raw Materials Act, which sets targets for 2030, including extracting 10% of the EU's annual consumption, processing 40%, and recycling 25% of these essential materials. Quote, Europe currently depends on third countries for many of the raw materials it needs the most. We must increase our own production, diversify our external supply, and make stockpiles, end quote, EU Executive Vice President for Prosperity and Industrial Strategy Stéphane Séjourné said in a statement. They focus on key metals and minerals such as aluminum, boron, copper, cobalt, graphite, lithium, nickel, and rare earths. Of the 47 initiatives, 25 involve extraction, 24 focusing on processing, and 10 are dedicated to recycling, with some covering multiple functions, the EU Commission said. And just a couple of more stories here. So we had a big earthquake in Myanmar, as many of you have heard. Tin prices jumped on this news. As it says here, this is Reuters via mining.com. Tin prices hit 2-week highs in London on Friday as speculators bet that an earthquake that rocked the major producer Myanmar could delay a restart of production in its main mining region. Myanmar is the world's third largest tin producer and a dominant supplier to China. Mines in tin-rich Wa State, which produce 70% of Myanmar's tin, are about 425 kilometers away from the earthquake epicenter, which according to the United States Geological Survey was near the Myanmar city of Mandalay. And we have a quote from Tom Langston, senior market analyst at the International Tin Association. Quote, the rise in LME price is likely speculatively driven, but we should get a clearer picture soon. End quote. So a little bit of uncertainty in the tin market. Also in Myanmar, we have a headline from Reuters via mining.com. Myanmar rebels disrupt China rare earth trade, sparking regional scramble. So we've been following this story about Myanmar, the rare earths, the rebels taking over rare earths hubs on the border of China, this kind of underplayed story in the larger media. Let's see what it says here. This is Reuters via mining.com. When army rebels seized northern Myanmar's rare earths mining belt in October, they dealt a blow to the country's embattled military junta and wrested control of a key global resource. By capturing sites that produce roughly half of the world's heavy rare earths, The Kia, or Kachin Independence Army, rebels have been able to throttle the supply of minerals used in wind turbines and electric vehicles, sending prices of one key element skyward. The Kia is seeking leverage against neighboring China, which supports the junta and has invested heavily in rare earths mining in Myanmar's Kachin state, according to two people familiar with the matter. Chinese import of rare earth oxides and compounds from Myanmar dropped to 311 metric tons in February, down 89% compared to a year ago period, according to Chinese customs data that hasn't been previously reported. Most of the fall came after October. Just to repeat that, Chinese imports of rare earth oxides and compounds from Myanmar dropped 89% from a year ago in February. And here's a quote from Dan Sang Long, executive director of the nonprofit Kachinland Research Center, which studies Kachin sociopolitical issues. Quote, "They want to use rare earth reserves as a leverage in their negotiation with China," end quote. So again, this doesn't get much press, but I imagine from China's perspective, this is a big red alert, what's going on here. From the rare earth perspective, as well as this is a conflict that's taking place right on their border. So big story there. So with that, we have a wonderful show ahead of you, some head-turning news stories, metal prices, and more. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner, and on Instagram at The Northern Miner, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts, and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to Ian Graham, president of Iroko Resource, for this week's Spotlight.
Joining us today, I'm very pleased to welcome to the Northern Miner podcast for this week's Spotlight, Ian Graham, president of Iroko Resource. Ian, welcome to the show.
Hi, Adrian. Thanks for having me.
It's wonderful to have you, Ian. Looks like you're working on some very interesting things in Mexico. For those that are unfamiliar with Iroko Resource, can you tell us a little bit of background about the company and what you are up to?
Certainly. So Iroko was founded in 2006 and has been focused on exploration and development resource projects in northwest Mexico since that time. Its original involvement was the drilling of a gold deposit in Sonora, which was sold on to a developer and is a mine currently still in production. And we followed that with the commencement of a very long legal action that culminated in 2020 with the acquisition of a majority interest in the Santo Tomas copper deposit, also in northwest Mexico and straddling Sinaloa and Chihuahua borders. So a very compelling project located in an excellent jurisdiction on great infrastructure, and also in a community where people had very strong experience in major mining, in that they had worked at the El Sosal gold mine operated by Goldcorp in the past. So very good knowledge in the region of mining and of the standards and practice of mining. And as a result, some very good social support for mining. And the Santo Tomas project has been the focus of our work since.
Well, it is indeed a mining country, Mexico, isn't it? But it's kind of interesting, though. I mean, the last government, they were starting to sound like they wanted to come down heavier on regulation on mining in the country. How are you finding working in Mexico? Is it challenging right now, or has everything kind of blown over?
So 2 points on that, Adrian. Yes, we've experienced headwinds, particularly in the market, as a result of investor nervousness regarding the direction of the last federal administration under the president widely known as AMLO. 2 points. Our historical rights to develop are protected under the Mexican Constitution, and we have filed all the necessary legal proceedings to protect those rights. But most recently, in fact, as recent as last week, we were visited by a former senator of the federal government and now a congressman, a deputy in the equivalent of the Mexican Congress. And he spent Thursday and Friday of last week with us and has agreed that the project is required for the regional social stability and creation of jobs, and we'll be championing the project through all the phases to development. And that is an exciting change for us. I think it's a sea change. And he has further posted his support for the project on X and on Facebook, and we'll be further engaging with him in Mexico City, together with the Secretary for the Economy, think Minister of Finance, and the Governor of Sinaloa, with whom we currently have a good relationship, to roadmap the further development of Santo Tomas. And we need that support, both to broadcast to the investment community, to underwrite a little further work that we need to do, which is basically the drilling towards a PFS study and the conversion of some of the Santo Tomas resource into the indicated category. So currently we have part of the resource and indicated. We need to add to that in order to prepare the project for our ultimate aim, which is a transaction with a large developer that would ensure the development of the project.
Okay, excellent. So Santo Tomas is the main flagship project then of the company, and that is in Mexico. Can you tell us a little bit more about it? You said it was a copper project. What have you found, and what do you think is there?
So what we have at Santo Tomas is a very large porphyry copper deposit. And much of the world's copper, the majority of the world's copper currently is produced from porphyry deposits globally. What we've defined at Santo Tomas is a project which is readily buildable at very competitive capital costs to produce from a large resource. And currently, we would mine some 825 million tons and produce over 5 billion pounds of copper equivalent. And that would be done mining from a resource of 8.5 billion pounds of copper. So the project economics are very good. It's a 1.48 billion US dollar post-tax NPV8, 22.2 post-tax IRR, so excellent project metrics. And we would be mining 108,000 tons of copper equivalent a year on our project plan against a capex of 1.1 billion US dollars, giving us one of the more compelling capex NPV ratios in the undeveloped porphyry copper space globally. So it's a very, very compelling project. Clearly, a developer would be able to change some of those metrics, mine it a little faster, or make other improvisations that may improve the economics or better suit their global marketing. But in any case, this is a very compelling project. And the reason the capital is so relatively low is that the project is situated on very compelling infrastructure. So we're on road, rail, a Trans-Canada natural gas pipeline with excess capacity that runs right by the project. We're also on hydroelectric offtake locations for the national grid here in Mexico, and we're a short drive, 160 kilometers by road, to Topolobampo, which is an excess capacity deep water port on the Baja coast. So it's a very well-blessed project in terms of its location.
Okay, excellent. And I'm looking at the team here, and they look like they have quite a bit of experience. So as far as the roadmap, then, how do you see things playing out in, say, like the next 6 months to 2 years, let's say? How do you see things moving forward with the company?
Adrian, I think that period is a very compelling one for us. With the recent engagement by the federal government on our behalf and the continued support of the state government, we're looking to shortly publish a desk prospectus that would allow us to finance in the near term to commence work on the PFS that I referenced previously. The PFS requires between 15 and 20,000 meters of drilling to complete. To date, we have drilled 50,000 meters. So this is certainly on the downhill slope for us in terms of project scope and scale. But with that additional drilling, we'll move the so-called south zone of the project into the indicated category. We'll complete a PFS, further map out some of the geotechnical and geohydrological requirements of the project, all of which we expect to be quite supportive of the current plan, and then do that work ideally by the beginning of next year, and then in the course of early 2026, publish the PFS with an updated resource, and then move the project towards its ultimate transaction, which we would love to see crystallize in 2026, but not everything proceeds at the pace you might best hope of. However, we do expect that by 2027, we should look forward to a very compelling transaction that would greatly benefit the shareholders of Oroco.
Okay, excellent. So what do you want investors to know about Oroco Resource?
I think, firstly, Adrian, that we are refocused now, given the government support that we have, on moving this project forward in an expedited manner. As you referenced earlier, we have excellent technical leadership under Richard Locke, our CEO, who is a serial project developer, and his record is on time, on budget development. So he brings very, very strong focus and technical credibility to the studies we do. We will also be now focusing on messaging the company and the government support that we have and the exciting near-term catalysts that we are confronting. And so investors can expect renewed support of the company in the broader market. They can expect to see a PFS move forward with a renewed resource, particularly at South Zone. And I believe that we're now poised for a very exciting 6 to 24 months that you previously referenced.
Ian Graham, president of Oroco Resource, thank you for joining us and sharing everything that you're working on at the Santo Tomas project in Mexico.
Thanks very much, Adrian. Thanks for having us.
And thank you once again to Oroco Resource for sponsoring this week's episode of the Northern Miner Podcast. If you want to learn more, visit orocoresourcecorp.com. Turning to the website, another head-turning story. The Metals Company says it may defy United Nations. This is by Henry Lazenby at the Northern Miner. The Metals Company is threatening to bypass United Nations deep-sea mining regulations unless the UN's International Seabed Authority speeds up its rule modernization process. TMC, also known as the Metals Company, has invested more than $500 million in studying the Clarion-Clipperton Zone off Nauru and Tonga during the past decade. Now it's losing patience with the regulatory body, which has been working on finalizing a set of international seabed mining rules in a process dragging on for years. And here's a quote from Chairman and CEO Gerard Barron, who said late Thursday on an investor call. Quote, "The ISA's timeline drift and failure to deliver its legal obligation of adopting a mining code does not change one key fact, and that is that we are ready. What we need is a fair hearing and a regulator willing to engage. Thankfully, we have another path forward." End quote. TMC, in partnership with the Republic of Nauru, plans to submit its first application to mine the seafloor on June 27th, ahead of the ISA's second annual meeting in July. Opponents have been calling for more study before large-scale extraction begins because they say deep-sea mining's long-term effects remain unknown. Supporters say the industry is needed to meet projected mineral demand. TMC shares have risen since the start of the year as support grows for deep-sea mining under the Trump administration. In December, the House of Representatives approved a defense funding bill and asked the Secretary of Defense to study how to process deep-sea minerals in the United States. TMC shares rose on Friday, boosting their gains since the start of the year to about 54%. That gives the company a market capitalization of $592 million. And so, subheadline here, 1980s loophole. The company is to use the Deep Seabed Hard Mineral Resources Act of 1980 to launch an application before the end of June. That law, which came after tests and environmental impact assessments in the 1970s, provides a U.S. path for exploring and commercially recovering polymetallic deep-sea nodules, avoiding delays at the ISA. This authority has not yet fulfilled its mandate to set exploitation rules under the UN Convention on the Law of the Sea, which applies to its members. The U.S. hasn't ratified the UN Convention and isn't a member, which has led groups like Greenpeace to say that U.S. deep-sea mining would break international law. Most countries see the convention as a customary law. TMC has asked for a pre-application consultation with the National Oceanic and Atmospheric Administration, which is part of the U.S. Department of Commerce. Company executives have also met with officials from the White House and Congress. So, just raises a lot of questions. Let's continue. Greenland needs U.S. EU commitment to buying critical minerals, top banker says. This is Bloomberg News via mining.com. Greenland needs purchase commitments from either the U.S. or the European Union to unlock investments in critical minerals, according to the head of the island's largest bank. Greenland's critical raw materials provide, quote, a new opportunity, end quote, to bolster the territory's economy and a chance for Western powers to wean off dependence on China for key resources, said Bank of Greenland Chief Executive Officer Martin Kvisgaard. And here's the quote, quote, what we're missing is the EU or the US stepping up and saying, we'll take these raw materials. China has built its dominance in the sector by doing exactly that. We need a new way of thinking about how to become independent from China, and that could be by making concrete buyer agreements, end quote. Again, I'm just kind of like, where's this going to be processed? Scrolling down, this month, the general election on the island ended with 3 in 4 voters backing parties that support a gradual pathway to sovereignty, rather than a swift break from Denmark. The outcome has calmed investors who had been rattled by Trump's talks of taking control over the world's largest island. Quote, my horror scenario was something similar to Brexit, a headlong withdrawal from the Commonwealth without any solution, end quote, Kvisgaard said, adding that it would have sent Greenland into a, quote, extremely turbulent and risky period. I consider this scenario to be off the table with the election result. It provides peace of mind for both investors and funding sources, end quote. Continuing on, U.S. pushing for more expansive minerals deal with Ukraine. This is Reuters on March 28th, so another ongoing saga here. And this is Reuters via mining.com on March 28th. The Trump administration has proposed a new, more expansive minerals deal with Ukraine, according to 3 people familiar with the ongoing negotiations, and a summary of a draft proposal obtained by Reuters. The U.S. has revised its original proposal, said the sources, and it gives Ukraine no future security guarantees, but requires it to contribute to a joint investment fund, all income from the use of natural resources managed by state and private enterprises across Ukrainian territory. The terms put forward by Washington go well beyond the deal discussed in the days leading up to the contentious Oval Office meeting last month between U.S. President Donald Trump and Ukraine President Volodymyr Zelensky. Treasury Secretary Scott Bessent has been leading negotiations for the United States, said one of the sources. The proposal makes no mention of the U.S. taking ownership of Ukraine's nuclear power plants, according to the summary, something Trump had talked about. Trump had said a minerals deal will help secure a peace agreement by giving the United States a financial stake in Ukraine's future. He also sees it as America's way of earning back some of the tens of billions of dollars it has given to Ukraine in financial and military aid since Russia invaded 3 years ago. So it continues over there. A related story, Russia, U.S. in talks over rare earth JVs. And this is according to a report. This is Cecilia Jamasmy at northernminer.com. Washington and Moscow have begun discussions on joint rare earth projects in Russia. The head of the country's sovereign wealth fund, Kirill Dmitriev, told pro-Kremlin Russian newspaper Izvestia on Monday. Dmitriev, who was part of Russia's negotiating team at talks with U.S. officials in Saudi Arabia in February, said some companies have expressed interest in potential joint ventures. Izvestia reported the cooperation on rare earths could be further discussed at the next round of Russia-U.S. talks, expected to take place in Saudi Arabia in the coming weeks. Russian President Vladimir Putin suggested in February that Washington might be open to exploring rare earth deposits in Russia, which holds the world's 5th largest reserves of the metals used in magnets, mobile phones, and military equipment. Putin said at the time he was open to working with foreign partners, including Americans. He listed various regions, including Siberia and Russia's Far East, as key regions for rare earth mining. The U.S. Geological Survey estimates Russia's reserves of rare earth metals at 3.8 million tons, but Moscow claims the actual figure is significantly higher. Continuing on, boom in uranium stocks fizzles as Ukraine ceasefire talks builds. And this is Bloomberg News via mining.com. Once booming uranium stocks have been veering towards bust mode to start 2025. Escalating trade tensions between the U.S. and Canada, one of the world's key producers of nuclear fuel, are playing a major part. Lately, so are talks towards a ceasefire in Russia's war in Ukraine, which raised the prospect of looser sanctions on Russia's production of the radioactive metal and the potential for more supply. The price of uranium, now down more than a third from early 2024, has slumped roughly 11% this year. The widely followed $2.9 billion Global X Uranium ETF, which mostly tracks mining shares, has declined about 5% in 2025. Meanwhile, Saskatchewan-based Cameco, the largest uranium miner in North America, has dropped 11% following 5 years of gains. So uranium stocks pull back. And here's a quote from John Champalia at Sprott Asset Management. Quote, "They're just blowing so much smoke at the market and nobody knows what's what. It just creates so much uncertainty that it's paralyzing people making decisions." End quote, and referring to tariffs out of the United States. And continuing on, CATL's lithium partner sees swings in near-term prices. This is Bloomberg News via mining.com. Jiangsu Local Tech, a Chinese battery material producer, said the lithium market will be volatile in the near term as supply growth outpaces demand. Price of the material key to electric vehicles and energy storage could swing between 65,000 yuan and 85,000 yuan a ton, which is about $9,000 to maybe $12,000 a ton in the short term, Chairman Xi Jinping said in an interview Friday. And here's a quote from Xi Jinping. Quote, "The lithium market is still in surplus and refiners, including our project, could be under a bit of pressure. But for the entire supply chain, the biggest pain point for the industry is overcapacity and vicious competition." End quote. And just a few headlines. Korea to boost mineral recycling to counter U.S.-China trade risks. This is Bloomberg News via mining.com. South Korea aims to achieve a 20% recycling rate for strategic critical minerals by 2030, as intensifying trade tensions between the U.S. and China expose the country to supply uncertainties. So boosting mineral recycling out of South Korea. And another headline, ArcelorMittal, South Africa, defers plant closure after $92 million injection. This is Reuters via mining.com. ArcelorMittal, South Africa, will defer the closure of its loss-making long steel plants to August 31st after getting a $91 million injection from state-owned Industrial Development Corporation, the steelmaker said on Monday. The steelmaker, which had been in talks with the government about a relief package, announced on February 28th it would cease long steel production by April after failing to get concessions on its demands. And finally, Glencore halts Chilean smelter in setback for U.S. copper rush. And this is Bloomberg News via mining.com. Glencore has suspended shipments from a copper smelter in Chile after an issue affecting the plant's furnace, a setback that comes just as traders and producers race to ship more metal to the U.S. ahead of tariffs. The company temporarily halted operations at the Alto Norte plant and activated so-called force majeure clauses in its commercial contracts. People familiar with the matter said, asking not to be identified because the information is private. The incident adds to recent outages at smelters and refineries in Asia, which could serve to tighten the metal market even further amid a worldwide dash to front-run potential tariffs by U.S. President Donald Trump. Copper futures on New York's COMEX exchange surged to a record on Tuesday. Those are your news stories. Now let's take a look at metal prices. And turning to metal prices, let's turn to the bond market for context. The U.S. 10-year bond is yielding 4.18%. That is down 0.18% from last week. The UK 10-year gilt is yielding 4.61%. That is down 0.14%, so also lower. Italy's 10-year bond is yielding 3.79%. That is 0.13% lower than last week. Germany's 10-year Bund is yielding 2.68%. That is down 0.14% from last week, and the Japanese 10-year bond is also lower, yielding 1.49%. That is down 0.09% from last week. So 10-year bond yields decidedly lower on the week. Turning to precious metals, gold is trading at $3,158.50 per ounce. That is $29 higher than last week. Silver is trading at $34.75 per ounce. That is 88 cents higher than last week. Platinum is also higher at $1,010.40 per ounce. That is $49 higher than last week, and palladium is trading at $983 even. That is $40 higher than last week. Turning to industrial metals, copper is trading at $5.02 per pound. That is 4 cents lower on the week. Iron ore is trading at $102.43 per metric ton. That is 43 cents higher on the week, so edging slightly higher. Aluminum is trading at $1.15 per pound. That is 3 cents lower than last week. Lead is trading at 92 cents per pound. That is a penny lower on the week. Nickel is trading at $7.22 per pound. That is 4 cents lower than last week. Tin is higher at $16.43 per pound. That is 81 cents higher than last week. So remarkable price on tin, of course, on the earthquake in Myanmar and also issues in the eastern DRC, the real world of mining. Cobalt is trading at $15.35 per pound. That is 10 cents higher than last week. Lithium is trading at $10.20 per kilogram. That is down 2 cents on the week. And once again, threatening the $10 handle on lithium. Uranium is trading at $64.35 per pound. That is down 70 cents on the week. And zinc is trading at $1.30 per pound. That is down 4 cents on the week. Zooming out, precious metals continue to rise while industrial metals chop sideways, likely on economic uncertainty. And those are your metal prices. Coming up, I'm very pleased to welcome back Cam Currie of Currie Metals and Mining Group, part of Canaccord Genuity. We go in depth on gold stocks and the value that is there. Is it time for a pullback? Where is the most value to be found in the market? And more. I hope you enjoy the conversation, and I will see you on the other side.
Join us today. I'm very pleased to welcome back to the Northern Miner Podcast, Cam Currie, Senior Investment Advisor at Currie Metals and Mining Group at Canaccord Genuity. Cam, welcome back to the show.
Thank you once again for having me.
Well, it's a fortuitous day to have you. New record here in gold, $3,107. You know, you've talked about narrative economics in the past. Big picture, what's going on here? Why is gold at a new record in your view?
Adrian, you've been interviewing me for a couple of years now, and my thesis has been consistent throughout. I've talked about the fact that zero interest rates rendered debt leverage to the point where we went from $200 to $300 trillion in debt. So you look at growth off of asset appreciation, and that created the wealth effect, which would create the economics. Then you have these different subsectors. Right now, AI, there's driving momentum on indexes and that. But the underlying foundations of this economy now are being challenged. And we can get into this in multiple ways. But, you know, on the gold front right now, quite honestly, I mean, the U.S. is slowly waking up to it, but in a large way, they're still oblivious to the fact of what's taking place in the gold market. You know, you have the autocracies and the other central banks of the world no longer viewing U.S. treasuries and U.S. dollar as a safe haven reserve currency of choice. And they are diversifying out of that. And gold now is becoming a reserve currency. It's the second largest reserve currency held, third being the euro. And as the U.S. dollar weakens, which still hasn't taken place yet because of, quote unquote, the American exceptionalism, what's going to happen here is when the dollar rolls over, Americans are going to realize what are they going to do to hedge their U.S. dollar assets? And I just had my 3 analysts go through New York 2 days ago, and the funds still are not paying attention to the gold market, believe it or not. They're trying to figure out if NVIDIA is a buy on this dip and what's going on there. So when they realize that there's a shift taking place and gold as an asset class is something that they have to have in their portfolio, that's when we're going to start seeing some real flows into the sector. We saw 23 tons of gold into the ETF 2 days ago. That was the biggest increase in purchases since 2021. So there is some wake-ups, but the reality is the masses are oblivious to this move.
Very interesting. So in a sense, what you're saying is the allocations are still surprisingly low, and the mining industry itself is not like a massive market relative to, say, stocks like NVIDIA and, the Mag 7. So what you're saying, in other words, is when this rotation takes place, it could be fireworks. Is that accurate?
Well, just to put it in perspective, when NVIDIA had that shift down on that DeepSeek announcement, NVIDIA lost $600 billion in market value in one day. Okay. The market cap of all the gold mining companies in the world is around $600 billion.
Right. That was actually exactly the kind of number I was looking for. So, despite maybe allocations being low, I would still say sentiment seems fairly buoyant. Do you think that's overstating things? Like, in a sense, how do you feel about sentiment? I mean, you've mentioned narrative economics in the past. How is the story of gold right now in precious metals? What is your assessment?
You know, we're at $3,100 gold right now. I remember gold going through 2000. I thought the market would wake up then. But again, the market chasing the narrative of US equities and US sectors like AI, et cetera, has basically overshadowed any interest in what's happening in the gold markets right now. And so, in terms of the market perspective on it, we're still, believe it or not, very early. And, I think what's going to happen here is, today, for example, Lululemon just came out with their numbers. They're disappointed and they're guiding lower with consumer weakness. And we've been talking about the consumer getting tapped out. We have record credit card debt. We have record stock ownership in US equities, record real estate prices. And people are underestimating the impact that asset depreciation is going to have on the wealth effect on the consumer. And as the US slips into recession and the dollar starts to weaken, this year alone, there's $7 trillion worth of treasuries that have to be refinanced. Now, how are you going to refinance treasuries in a declining currency? And that's the thing that's so obvious to me. And that's why you're seeing this demand for gold from outside the US looking in. Because the Americans this exceptionalism is basically, they're living inside of a bubble. The rest of the world is voting right now. And now you've got Trump doing what he's doing. And what he's doing is he's isolating America. And in doing that, the rest of the world is looking at US dollars, US treasuries, US investments and going, you know what? We don't have that as our number one choice. And that's one of the reasons why gold's going higher.
Very interesting. And so when you look at the wider world, then, particularly autocracies, you would say they have an appetite for gold. Is it just the autocracies?
Well, again, it goes back to the SWIFT system. And you're seeing what Trump's doing. He's using tariffs as a weapon. I mean, already the US dollar was weaponized. Now he's using tariffs as a weapon around the world. For example, I've used this before in one of our interviews that right now, India imports 36 times more oil out of Russia than they did prior to the Ukraine invasion. So at what point here does Trump decide that he's going to start imposing some tariffs on India as a consequence of them buying the oil from Russia? I mean, who knows when he wakes up one morning and decides that? So if that's taking place, if you're traders of the world and you want to transact, having your transaction dollars in US dollars becomes a risky proposition. So what's happening right now, for example, when India buys oil from Russia, they're using gold as collateral and trading in their own currencies outside of the US dollar. And again, no one talks about this. And so gold is a reserve currency and it is a transaction currency. It's a collateral currency. And as it keeps on being bought, the appreciation of it only creates greater wealth for these central banks as well.
Very interesting. And it is, I was talking to Jeffrey Christian a few weeks ago. It's a surprisingly liquid market. Like it's the real deal, to state the obvious, gold, right? It's kind of impressive in that regard where, if Poland wants to buy $10 billion of gold, okay, here you go. Now, we've seen quite a price appreciation though, however, and I'm just kind of curious at Currie Metals and Mining Group, do you use technical analysis? It's just something I'm curious about these days.
It's definitely a tool. But I'm a fundamentalist. But as I say that, today, for example, the Huey, which is the gold bug index in the United States, is just broken out through 360. And that's a new high in this cycle. But to put it in perspective, back in 2012, it was 660. Okay, so part of the problem here, and we've talked about this before, is that one reason why it's there is because companies like Newmont and Barrick are far down from where they were because of their declining productions. But the point being is that what we see taking place here is going back to the technicals, the algos and the quant programs are constantly reading the rate of changes. And so for the first time, we actually have the breakout in the gold indexes at a time when the Dow and the NASDAQ and the S&P are starting to show some breakdown. And that is so important to a shift in sentiment towards people buying gold and gold equities because people chase momentum. To buy something of value, the value investing has become a thing of the past, it seems. It seems like passive funds drive everything. And as I've said before, price action creates a narrative, and narrative creates ETF flows. And we're getting ETF flows into the gold bullion. We're getting some into the gold equities. But when you start looking at the numbers, there's like 12 senior mining companies, 15 mid-tiers, if that. And you start adding up how few companies there are. When the money flows start going into the ETFs, they start spraying into these companies. The price action will draw in the fund managers to come in because price action draws their attention. And going back to your question about technical analysis, these algos and quants that are constantly mining the world looking for rate of changes, all of a sudden, I can guarantee you right now, there's some flags going off on what's going on in the gold market. And going back to it, I mean, when we start seeing money flows into this space and it creates price action, that's when people start talking about it and then it builds upon itself. I mean, it's hard to believe at $3,100 gold, I'm sitting here, and honestly, the phones are crickets still. My analysts are getting very few inbounds. 2 days ago on CNBC, they were talking about gold breaking out, and two of the commentators, well, what do you do with gold? It doesn't pay you any interest, and you just stick it in a vault? Well, it's an asset class. And if you really look at, you want to talk about asset classes, the US dollar has lost 96% of its purchasing power over the last 25 years. So what asset class would preserve value? Gold. Look what gold's done since the US dollar has lost 96% of its purchasing power. So technicals are definitely a factor, and they will flag these algos and quant programs, and that'll be a trigger.
Interesting. And so the ETFs are somewhat of a key here in terms of understanding flows. What are the main ETFs? As far as I remember, it's GDX, GDXJ, and the Huey. And I guess there's the silver ones, isn't it SIL and SILJ? Are there any that you kind of think are?
Those are the primary ones you're talking about, and they are. But just, you have to understand, ETFs get invented when markets see the opportunity to make money. And I heard this quote the other day when Meta was at its all-time high. Meta is owned in the top 5 position as a top 5 holding in over 400 ETFs. Now think about that. Meta has over 400 ETFs holding it as a top 5 holding. Now, right now, we have how many ETFs in the gold market? Well, what happens when all of a sudden they start, tagging a gold weighting in other ETFs? So this market will create more and more ETFs to flow into the gold equities as a price action, and the narrative shifts towards gold as an asset class. So what we have right now is a minor amount of ETFs. That's one reason why the price action's been, challenging. But as I say that, you look at the companies that have been very well indexed. I mean, you look at Lundin Gold, you look at G Mining, you look at Eldorado, the mid tiers that are delivered. You can just see the spray-ins of the indexes as they spray into these things. So we've had some phenomenal gains in a number of our stocks here. I mean, let's face it. I mean, how many people are investing in the last 3 months that are up 100%? And that's our performance.
I imagine you're also interested in silver. How is silver factoring into your view right now?
Well, as you say that, I just bought a 10-kilo bar sitting on my desk. I got it yesterday as silver broke out through $35, which is a new high. Silver is a leverage play of gold. I love silver. I think silver is going substantially higher. The challenge is trying to find pure silver plays because there are very few. Silver is pretty much a byproduct of a lot of base metal producers. But the pure silver plays, there's very few and far between. And the ones I am very heavily weighted in, they're trading new highs today. And yet no one's talking about it. By the way, I've been through many cycles. It makes me more and more bullish when no one's talking about it. Because I remember 2003, 2004, when gold went through 400. I was looking over my shoulder going, is nobody paying attention? And the next 5 years, I think we made 700% on our money.
It was before my time. I got in around 2009 when I started paying attention, but unfortunately a few years too late on that because it seemed like a historic bull market there with China coming on board and all the commodities going. Generally speaking, do you have another sense of, say, like copper and other metals going along for the ride, so to speak? Is this a general, metals bull market in your view?
Well, it's funny. I love copper long term. And I've made a lot of money for my clients on copper. We were very fortunate to go alongside the Lundin family on Filo in its early days. And as you know, it was taken over by BHP and Lundin Mining. Copper is a scarcity story. I mean, demand's one thing. Electrification is a huge component going forward, especially with technology and AI. But I'm also of the opinion that we are going to recession. So the copper stocks have not been performing that well relative to copper trading new highs. And that should be a warning sign that economic slowdown is coming. I can't predict what copper price is going to do here, but I'm going to become a very, very big buyer of copper stocks at some point here. But right now, I just think the leverage on the gold market right now, I mean, some of these companies we're buying right now are trading at 0.14 times NAV. If you look at gold price today, they're trading at 1.5, 2.5 times EBITDA. And these companies are puking cash right now. I mean, you look at Lundin Gold right now. I mean, within 12 months, they'll have $1 billion in their balance sheet, debt-free, paying a 4.5% dividend yield. I mean, these companies at this gold price are going to pay off their debt very quickly And the dividends that we're going to be getting for our companies is going to be significant as we move forward here. So I'm very focused on that, but I love copper long term. I'm just trying to figure out when the entry point is.
Okay, excellent. And in terms of the streaming companies, I mean, they're quite popular, it seemed, say, I don't know, I guess we're going on 15 years ago. It seemed to me Silver Wheaton had a big run. And how are you feeling about streaming companies these days and royalty companies?
Well, I've never been a buyer of streaming and royalty companies. I mean, in hindsight, perhaps I should have been, but what they provide is an exposure for the generalist funds to get exposure without having geopolitical and project risks. Mind you, as I say that, you look at First Quantum's asset, Cobre, that became a risk to Franco on their royalty position. But very rarely does that happen, right? And so it's a safer way of playing for the generalist funds to buy. But I look for the best performing assets and management teams on assets that can grow. And we've had great success. We've also had disappointments. I mean, the one thing about the mining space is you can be 99% right, 1% wrong, and still lose a lot of money. I mean, that's the reality. I mean, you can have a geopolitical event, a geological event that you just don't foresee. But when it comes to management teams, I mean, one of the things I do want to point out about a year ago, and this is a very important interview that most people should go back and listen to. Amar from Agnico Eagle, a year ago this past February at the BMO conference, talked about gold and gold equities, specifically Agnico Eagle. And what he referred to, because they're asking about where gold price is going and where his company is going and how come the stocks aren't reacting. Gold was at 2,200, Agnico was at 85. Fast forward to today, gold's at 3,100, Agnico's breaking new highs at $155. But here's the key point. He was making reference to the major shareholders that owned Agnico. And he said, we have some of the biggest funds in America in our stock, the big ones. And this is what they're telling us. And this is going back a year ago. They're saying to us that they're watching gold. They're watching us, but they have to be playing in the arena they're playing in. They're playing the S&P and the Fab Sevens and the NVIDIAs and that, because that's where the market's demanding for them to play. But they're getting concerned. They're getting concerned about valuations. They're getting concerned about deficits. They're getting concerned about politics. And that was over a year ago, way before Trump came in. But fast forward to today, Amar was at the conference a month ago. One of my clients had dinner with him, and he said the setup for gold today is even greater than it was back then, because those big funds are recognizing the risks in the marketplace. And these funds, this is what they were telling him. Since 1920, there's been 15 market corrections of about 35%. And of those 15, 14 of them, gold went up by 45%. Well, here we have these markets clearly looking like they're rolling over and gold breaking new highs. So just pay attention to what he's saying, because he's a barometer of what the big funds are talking about in the United States. So this gold market is just starting to get some real traction. And like I said, there's very few companies. So when the money starts spraying into these stocks, I mean, I think I mentioned to you before, indexes are absolutely everything. And the QQQ is the NASDAQ 100. The last week of December, there's 3 names added to that. MicroStrategies, which is the Bitcoin holding company of Michael Saylor's, okay, trading at that time 4 times book value. Palantir Securities was trading around $80, trading 180 times PE multiple, ran to 120, 250 times PE multiple. And the third addition was a company called Axon, which is tasers and body cam, which was a meme stock for Trump with his movement to get rid of illegal immigrants. So those 3 companies, which were grossly overpriced, were added to the QQQs the last week of December. But the average person who's buying those ETFs has no idea that they're actually buying those stocks. And that's the setup we're in right now. So everyone's chasing momentum and chasing narratives. Valuations have lost their way. And here we are buying our gold stocks right now, trading at 2-3 times EBITDA.
Right. So in a sense, this is value investing, to state the obvious.
Absolutely.
In terms of the miners, then, since you seem to look at a lot of these companies fairly close, how are they doing for costs? I mean, I think the average all-in sustaining costs these days is all the way up at $1,500.
That's correct.
How is inflation? Some people say that's part of the reason why gold stocks were kind of laggards, even though now we're starting to see some movement. What is your sense of the inflation and costs for miners?
Well, the ASIC right now is, let's say, 1,500. And some companies are higher, some companies are lower. But gold's at 3,000. Now, tell me how many businesses in the world right now offer that type of margin, right? I was watching a report I watched the Sprott report the other day, and they were talking about the comparison of the gold stocks compared to the average S&P. And the dividend yield of the gold companies is 1.5 times that of the S&P, and the PE multiples are half that of the S&P. And the debt level of the gold companies relative to the average S&P is half the S&P. So where's the better value right now?
Interesting. Again, a value play. So here's a controversial question for you. The miners, I think back in that bull market you were telling me about in 2004, a lot of the gold miners, from what I understood, they hedged. And that's why sometimes after that bull run, it was seen that they weren't as profitable, if I have the story right. Should miners, hedge at $3,100 gold, or should they ride this out, so to speak? Like, what is your opinion,
Well,
so to speak, on hedging?
Well, I've always been a non-hedging individual. The only time I see people taking a portion of their production hedging is when they've taken on debt to build a mine. And that way they lock in so they have greater clarity, but only a small portion of their future production. So that's a defensive management move. But in terms of going forward as a growth company, I mean, I'm not buying a gold company to be locked in at $2,800 gold, right?
Right. So in a sense, if it keeps going up, your leverage is reduced.
Absolutely.
In terms of jurisdiction as well, for those, that are thinking about buying individual stocks, what is your sense of jurisdiction right now? I mean, are there places that you're excited about? Are there places that you stay away from? I imagine there are on both counts.
Well, jurisdiction is always a measurement of risk. But again, I think I've mentioned this before. I mean, you start looking at jurisdictions, from first drill hole to first ounce, and the average mine is 17 years. Okay. So you try to get permits in Nevada. I think it's changing now with Trump in position because he just made gold a critical mineral as well. So I think he's fast tracking permits. But permitting in the G8 countries and that can take quite some time. Whereas, the largest mining district in the world is West Africa. But people perceive that as a great risk because of, the Niger thing and, just the uncertainty of West Africa. But the reality is you're going to have first drill hole to first ounce is like 7 years. We've had great success there, but the narrative and the concern creates a lot of caution for investors to go there. But at the end of the day, if you're producing and you're making significant profits, profits will dictate people realizing that it's not as risky as it was or perceived.
For the retail investor, I mean, I once bought gold. I found it was pretty expensive to get in and out of. And so my instincts would probably be, okay, I'll just buy, GLD, get an ETF at this point. But I suppose maybe it depends on how many assets you have and how large your assets are. What is your view on, say, physical? How do you approach that?
Well, physical is percentage move, and gold stocks are a multiple of that. Because if you have gold go up by $500, that $500 flows to the bottom line of the miners. So the leverage magnifies on a profitability scale. But that's why I find it interesting. I mean, I have one of my clients, gold's gone from 2,000 to 3,000. So it's up 50%. And our stocks, I think, are up around 85%. And they should be up significantly more. But there's a couple companies in there in West Africa that haven't performed because, again, the money flows into that arena have been staved because of, North American views of what's going on there. So, I don't buy GLD. My job is to buy companies that are going to outperform the indexes. If you buy the ETFs, for example, you're buying Newmont and Barrick, which have largely underperformed. Whereas the number of our seniors and mid-tiers are up 100% here in the last year. So the performance is company specific.
As we start to wrap up here, Cam, what is your advice for investors then, for those who are looking to dip their toes in the water? Maybe they don't have any gold stocks or mining stocks, but maybe they feel like, hey, things have already moved dramatically. What kind of advice, though, would you have for people who are just wanting to learn about the market? How should they approach this?
Well, first of all, it's very few people are taking the time to pay attention to what's going on, right? I mean, record U.S. stock ownership a month ago in these U.S. equities. Okay, so that's where they're playing. A lot of people haven't even started looking at this sector. And so, number one, you have to find somebody that knows what they're doing. And, that's my specialty. I mean, if you want to invest in AI, you want to find somebody who specializes in AI to get a competitive advantage. And right now, in Canada, for example, most investors of today are passive investors. They just have their wealth with a wealth manager who does plug and play ETFs, because that's what they do. People that are stock pickers and specialists in the mining space, like myself, are very few and far between. And quite honestly, that's why I'm also so bullish, is because gold's at all-time highs, and we don't see a lot of people moving their money into this space yet, which tells me, believe it or not, we're still early. Everyone thinks, oh my gosh, gold's at 3,100. Well, Bitcoin started where? At 5 cents. And again, I've said this many, many times. If you're looking down the world today and you had to buy a basket of currencies, okay, given the political stewardship, the debt leverage, and the printing presses of central bankers, what would be in that basket? And gold's the only currency in the world that has no political attachment, no debt obligation, and no printing press. And that's why the central banks continue to buy it. That's why smart investors continue to buy it, because they're getting more and more concerned about the stewardship. And with what's going on in America now kind of creating an isolationist situation for themselves. I mean, they're treating their G8 partners as if they're enemies. So how is that going to end? So would you want to keep on buying that debt? Would you keep on wanting to buy that U.S. currency? Or would you look for an alternative? And the fact that that narrative hasn't gone mainstream yet tells me we're still early.
And just one final question. In terms of, say, big caps or mid caps or, explorers or mid-tier developers, is there sort of a preference right now, or is it just sort of all of the above type thing?
Well, a lot of these mid-tiers have had significant price action moves. And, as I said, Agnico was gone from $85 to $155. We're long those. But the real opportunity right now is in the next level down, because as I mentioned before, you get these indexes that spray into these stocks, right? When companies are $300, $400, $500 million market cap, they don't qualify for the index weightings. But as they get into a volume in their stock and a price market cap, then they get indexed into these companies. And we've got 4 of our companies right now that are trading new highs, but they still aren't indexed. So what happens when these companies, all of a sudden there's 15 million shares of buy side coming in from index weighting? So that's the space where the real opportunity is, in my view, because those are the companies that are doing extremely well, but because they don't have ETF or index weightings, they don't have money flows going in. Because again, there's very few people like myself that are buyers in the marketplace, because the investment advisor of today doesn't specialize in the mining space. And that's my competitive advantage.
Any final thoughts on anything we haven't mentioned here that you want the audience to know on mining stocks, gold, precious metals?
Well, I think the big thing people have to pay attention to is the economic landscape. We're sliding into recession. And when you go into recession, sure, Doge wants to cut costs in the United States, but that's going to increase unemployment. It's going to lower tax revenues. And their deficit is still going to be where it is. I mean, they can cut it all they want, but the reality is the deficit's a deficit, interest costs are interest costs. And I think one of the things that people are going to realize at some point here is when the US dollar starts to roll over here, where are you going to go? And that's when they're going to actually start chasing gold, because then they're going to go, oh, if US dollar is going down, for example, US dollar lost 2.5%, I guess, over 2 weeks ago. If you're buying 10-year treasuries giving you a 4% yield, you just lost 2.5% of the 4% in the currency loss. So gold's been going up. So at some point here, people are going to recognize there's risks to the U.S. system right now, U.S. dollar. And that's when gold will get a narrative. And then people will validate it. And when it gets validated, we've seen this happen. I mean, you look what's get validated in U.S. equities. And these companies, when they start becoming the in validation, we all know what happens. And believe it or not, we're still at $3,100 gold. It's still not on the radar.
Cam Currie, Senior Investment Advisor at Currie Metals and Mining Group at Canaccord Genuity. Thank you for joining us and sharing all your insights on the precious metals markets.
Thank you very much, Adrian. Much appreciated.
Thank you once again to Oroco Resource for sponsoring this week's episode of the Northern Miner Podcast. If you want to learn more, visit orocoresourcecorp.com. And thank you once again to Cam Currie for sharing all of the interesting insight on the gold stocks and the gold market and silver, copper, and more. And thank you, dear listener, for continuing to support this program. If you want to help out the podcast, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.